Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. This time we're diving into Easterly Government Property's latest proxy statement. It's like the annual report card, but instead of math scores, we're looking at how the company's doing with things like choosing directors and paying its top executives. Let's see if they're earning straight A's or if there are some areas needing improvement, maybe even a little corporate detention. First up, the basics. This is a standard filing, meaning the company is the one sending it out, not some outside group trying to shake things up. It's essentially Easterly telling its investors, here's what we want you to vote on at the next meeting. So what's on the agenda for this annual meeting in May? There are three big items. First, electing the board of directors. These are the folks who oversee the whole operation. Second, there is a non-binding vote on executive compensation. This is where shareholders get to voice their opinion on whether the top bosses are paid fairly, though the company doesn't have to listen to that vote. Lastly, they're asking shareholders to ratify or approve their choice of PricewaterhouseCoopers LLP as their accounting firm, basically the people who check their financial homework. Now, how do you make your voice heard? You have to own stock as of March 18th. Each share gets one vote for each item, including each director spot. It's not cumulative voting, so you can't throw all your votes behind just one director nominee. Each nominee needs more for votes than against to get elected. For the other two proposals, it's a simple majority of the votes cast that wins the day. Abstentions and broken non-votes basically don't count. It's worth noting they did a reverse stock split on April 28th, but that won't affect anyone's vote. The company wants you to vote for all their choices, the directors, the executive pay, and the accounting firm. If you're curious about who these directors are, keep listening. They've got 7 nominees for the board, including Daryl Crate, who's now the CEO, and William Binney, who is the chairman. Let's look at these nominees because who they are matters to where the company is going. First, there's Daryl W. Crate, the current CEO. Before taking the top job, he was CFO of Affiliated Managers Group. Also, this is interesting, he was treasurer for Romney's presidential campaigns. Then there's William Binney, the chairman of the board. He's got a background in private investment, media, and real estate in New Hampshire. Next is Michael Abey, the Executive Vice President for Development and Acquisitions, and also Vice Chairman of the board. He's been in acquisition and development for a while, going back to the 1980s. Cynthia Fisher is an independent investor, entrepreneur, and advisor. She founded a company that does stem cell banking. She is also on the board of Boston Beer Company, the one who does Sam Adams. Scott Freeman is a managing partner at a real estate investment firm. Before that, he was with Colony Capital managing their global portfolio. Emil Henry is a former assistant secretary of the US Treasury. He's now the CEO of an infrastructure investment firm. And finally, Tara Innes. She was previously a managing director at AIG Investments. It's good to know that the board says that Binney, Fisher, Freeman, Henry, and Innes are independent under the rules. That means they don't have any strong connections to the company that could cloud their judgment. Speaking of directors, let's talk about what they get paid. Last year, non-employee directors got around $190,000, $115,000 in stock or units. If they chaired a committee, they got an extra $25,000. Not bad for attending a few meetings. Now, for the say on pay vote, shareholders get to weigh in on whether the executives are paid fairly. This vote isn't binding, but the company says it will pay attention to what shareholders think. So what did the company actually do this past year? This is where Easterly tries to justify those executive salaries. They acquired 10 properties, had development wins, had high leased occupancy with some financial results, and more balance sheet and capital market activities. And of course, they declared dividends. For the year, they made about $20 million in net income, or $0.19 per share. Their core funds from operations, which is a key metric for REITs, were $126 per share, so profitability is there. But the real question is at what cost? A big chunk of pay is tied to how the company performs, which makes sense, and they have stock ownership guidelines, so execs are invested in the company's long-term success. But who decides all this? The compensation committee, which is a group of independent directors, handles the pay decisions. They even hire outside consultants to make sure they're not overpaying compared to other companies. To figure out what's fair, Easterly compares itself to other REITs, which are companies that own and manage real estate. These include Torino Realty, Care Trust, and Diamond Rock, but honestly, there's no truly perfect comparison since Easterly focuses on government properties, which is kind of a niche. The top execs get a mix of base salary, bonuses, and stocker units. The company says that most of an executive's pay is at risk, meaning it depends on how well they and the company perform. So less guaranteed money and more you gotta earn it. The 2024 annual cash bonus was based half on company performance like core FFO per share and half on individual goals. This sounds good in theory, but how did it work out in practice? Let's scroll and see the numbers. Okay, so half of their bonuses depend on the company achieving certain goals of per share earnings, core FFO, managing their debt. Turns out the leadership got 100% of those goals. Looks good. On managing debt, they actually overperformed and received 200%. How did this materialize? Well, they did meet and in certain areas such as debt management exceed the thresholds. The end result, CEO Craig got a cool $1.75 million bonus. Marino got $375,000, Api snagged $875,000, and Logan pocketed $375,000. While it may sound like they all won, the report says the company made year-over-year increases to the threshold for those earnings numbers. We aren't sure if it's the whole truth. We will look and see. Another key piece of the pay package is long-term equity. This means giving executives company stock or units that vest over time. The stated goal is to reward success and align the executives with the shareholders. A chunk of it will vest based on company results, with other chunks determined if executives stay in their position for a long time. This is used for both long-term rewards and to incentivize folks to stay around. Some of these rewards are linked to what they call TSR, or total shareholder return, basically how well the stock does versus some index or treasury yield. Here's the thing, they only get the full amount if they do really well. Good governance wise, the filing states that company leaders are banned from using inside information to time their stock trades for optimal benefit. One thing that sticks out is their debt. This is quite normal in the real estate industry where they are incentivized to borrow money to buy things. They also have a clawback policy, meaning if they have to restate their earnings because something was off, they can claw back the bonuses. Good idea. Easterly also talks about its commitment to environmental sustainability. They're trying to make their buildings more energy efficient, get them certified as green, and even put solar panels on some of them. This is not just good PR. Easterly is committed to supporting small businesses in the communities in which they operate. That's not only great for the little guys, but it also helps the company build goodwill in those communities. Finally, let's look at who owns the company. BlackRock and Vanguard are the biggest shareholders, owning a large chunk of the stock. CEO Dale Crate has a decent stake, as does Michael E.B. Having the top people invested in the company's success can be a good thing, and so is Easterly on the right track. Here's the assessment of the company. They are taking steps toward ESG, environmental sustainability, and also improving the communities, which is generally great. They're relying a lot on continued government leases, a stable income, but not necessarily the most explosive one. In conclusion, Easterly is in a stable industry that it is positioned well in. If you believe in the long-term strength of Uncle Sam, this could be a good stock for you. Thanks for watching. If you found this analysis helpful, hit that like button, drop a comment, and subscribe for more corporate decoding.